Hello everyone, this is my very first video on the YouTube. So today we will be discussing regarding debt issuance cost and its treatment under US GAAP. Broadly, we will be dealing with these three aspects: concept of debt issuance cost, US GAAP accounting treatment before the amendment made by FASB through ASU 2015-03, and US GAAP accounting treatment after the amendment ASU 2015-03. Debt issuance cost. So debt issuance cost implies to the cost associated with debt issuances like loans, bonds, notes, etc. Few examples of debt issuance cost: various fees and commissions paid to the investment banks, auditors and regulators, underwriting charges, printing cost, legal fees and registration fees. Now let us talk about the accounting treatment prior to the amendment made by FASB through ASU 2015-03. Initially, the debt issuance cost is required to be recognized as an asset under other non-current assets and amortized as an expense, which can be termed as financing cost or as interest expense, over the duration of the debt instrument using straight line method, or you can alternatively use interest method. So the rationale is the matching concept of accounting. The borrower or debt issuer will reap benefits from the fund received over a number of years, and thus the related cost should be expensed over the life of the bond or the maturity of the bond. Now let us have a look over an illustration. A company issued 7.5% bonds with a face value of $100 million. The duration of bond is 5 years. Underwriting and legal fees associated with the issuance of bond is $1 million. As initial recognition, we will debit bank by 99 million. We will debit other assets, debt issuance cost 1 million, and will credit non-current liabilities 7.5% bond with 100 million. Now, at the end of the period, in the year in which bond was issued, so we will debit the financing cost, our expenses, and will credit other assets, the debt issuance cost with $0.2 million. So here we have divided the entire debt issuance cost through the maturity of the bond period. Note, this accounting entry shall be passed for next 4 years, that is up to the remaining life of the bond. Please note that straight line method has been used here for amortization of debt issuance cost. Alternatively, you can also use the interest rate method. Now, let us talk about the amendment made by FASB in 2015. In April 2015, FASB issued ASU 2015-03 to simplify the presentation of debt issuance cost. The same has been made effective for financial statements issued for fiscal years beginning after 15 December 2015 and interim periods within those fiscal year for public entities, and interim period within fiscal years beginning after 15 December 2016 for all other entities which are not public entities. As per the amendment, debt issuance cost shall be deducted directly from the debt liability as a contra liability, and no asset shall be recognized in the books. Relevant extract from the amendment has been stated below. Debt issuance cost related to a note shall be reported in the balance sheet as a direct deduction from the face amount of that note. The discount premium or debt issuance cost shall not be classified as a deferred charge or deferred credit. Please note that application of this amendment should be made on a retrospective basis and not on a prospective basis. Now, let's talk about the accounting treatment after amendment made by FASB through ASU 2015-03. Initial recognition as a deduction to the debt liability, that is contra liability, and amortization of debt issuance cost as an expense, which can be termed as financing cost, over the duration of the debt instrument. This can be done using the straight line method or the interest method. Here's an illustration. So, company issued 7.5% bonds with a face value of $100 million. Maturity period of bond is for 5 years. Underwriting and legal fees associated with the issuance of bond is $1 million. So, at initial recognition, we will debit bank account by $99 million to 7.5% bond account with $99 million. Subsequently, at the end of the period, we will debit financing cost, expenses to 7.5% bonds or liability. In this way, we are debiting our expense in the P&L and crediting the liability. That means we are increasing the debt liability. So, 1/5 of the debt issuance cost to be amortized every year. Note, this accounting entry shall be passed for next 4 years, that is up to the remaining life of the bond, and the carrying amount of bond shall reach to its original face value, that is $100 million. Please note, straight line method has been used for amortization of debt issuance costs here. Applicability on revolving credit facility subject to amendment made through ASU 2015-15. ASU 2015-03 was followed up by ASU 2015-15 to publish SEC staff guidance on accounting for debt issuance costs related to a line of credit or the revolving credit facility, since the same was not specifically addressed in ASU 2015-03. The SEC staff believes that debt issuance costs related to the revolving credit facility should be recorded as an asset, even if borrowings are outstanding under the arrangement at the reporting date. Since revolving credit facility is a standby commitment to provide borrowings over a period of time, which is an asset to the reporting entity. On the other hand, once term loans or specified maturity loans are granted and proceeds are received, no asset remains to be recognized. Few points to remember. Prior to ASU 2015-03, debt issuance cost is required to be recognized as an asset. However, post ASU 2015-03, debt issuance cost shall be directly deducted from the recognized debt liability as a contra liability. Secondly, debt issuance costs related to revolving credit facility shall continue to be recognized as an asset. Third, no change in the amortization of debt issuance cost as an expense. Thanks for watching this video. Please do share and subscribe for further updates.